I want to welcome to the podium Mike Bordeaux and Peter Ireland, who are members of our committee, but also Andy Levin. And Andy's not a member of our committee, but he was a co-author on a background paper that really forms the basis for some of Mike Bordeaux's comments. And so we thought it might be nice just to invite him up to sit at the table with us and participate more efficaciously in the discussion of their background paper as that comes up. But without any further ado, we will begin the proceedings. Let's see what the order is. And I think, Peter, you're going first.
So at our previous Shadow Open Market Committee meeting, I described how the Federal Reserve's new floor system, according to which it's manipulating the interest rate that it pays on reserves in order to target the federal funds rate, can be reinterpreted from a monetarist perspective as one in which the Fed can still use open market operations to influence the supply of reserves, but can also use this new policy tool, the interest rate that it pays on reserves, to influence the demand curve for reserves. The perspective is one that I call a monetarist perspective because it emphasizes and highlights that even though the details of the operating procedure that the Fed is using today are much different from those used in the past, it is still true on the most basic of economic levels that the Federal Reserve continues to exploit its role as monopoly supplier of base money to conduct monetary policy. And it's still true that by doing so, the Fed is achieving its principal economic function, which is to stabilize the aggregate nominal price level. But what I'd like to do today is to turn the issue around and ask if, from an economic perspective, the Fed is doing today with interest on reserves exactly the same thing that it did in the past with open market operations. Why stick with interest on reserves? Why not just go back to the old way of doing things, using open market operations to affect the supply of reserves, taking demand as given? Before answering that question, let me start by saying, and I was going to go into detail and a little more detail, but this came up too in the exchange between Charlie Calamiris and Guy Hazelman earlier today. In the short run, I'm just going to take it as given that the Fed will continue to pay interest on reserves as a way of finessing this problem that the FOMC has, wanting to tighten monetary policy even as it maintains a lot of the assets, all of the assets, or almost all of the assets that it acquired during quantitative easing on its balance sheet. The Fed now has goals, separate goals, for interest rate policy and balance sheet policy, which would be in direct conflict without paying interest on reserves. Basically, the Fed wants to tighten policy while keeping the supply curve for reserves shifted way out to the right in the graph. And the only way it can do that is by keeping the demand curve for reserves fixed or pinned way out to the right in the graph as well. And the only way it can do that is by paying interest on reserves. So I'm just going to accept for the sake of argument that this is the plan in the short run, but then focus instead on the long run. After balance sheet adjustment is finally over, should the Fed keep interest on reserves at center stage in its policy-making strategy, or should it jettison interest on reserves and just go back to using open market operations? To answer that question, we need to very briefly consider both the benefits and the costs in the long run of a policy that pays interest on reserves. So focusing first on the benefits, the traditional argument for paying interest on reserves is an economic efficiency argument, and it was articulated most forcefully by Milton Friedman in 1959 with his Program for Monetary Stability, although interestingly, the argument was actually first outlined by George Tolley 2 years before in a 1957 article from the Journal of Political Economy. But the argument is a basic microeconomic efficiency argument. It starts by observing that in a fiat money regime, a central bank can create an extra dollar of reserves at a resource cost that for all practical purposes is equal to zero. Economic efficiency then says that any good that can be produced at zero marginal cost ought to have a zero price in competitive equilibrium. The only slight twist in this particular argument, or in the application of the argument in this particular case, involves recognizing that reserves are more like a durable good. So their relevant notion of the price as it applies to reserves is something like a rental rate or a user cost, or in the case of reserves more specifically, the opportunity cost that a bank incurs when it holds an extra dollar in reserves. But having made that insight, then you complete the argument by observing, as Friedman and Talley did, that one way the central bank can reduce the opportunity cost to commercial banks of holding extra reserves is just by paying interest on them at a rate that closely approximates the interest rates available on other safe and highly liquid assets. So there we have the benefits of paying interest on reserves in the long run. What about the costs? The costs, it seems to me, take the form of two types of risk, neither of which was appreciated by Friedman and Talley when they did their original work in the late 1950s. The first risk is an economic risk. The second risk is a political risk. The economic risk comes about not so much because the Fed is paying interest on reserves, or even necessarily because it's operating with a big balance sheet. Instead, the risk arises because, in practice, the Federal Reserve has used its ability to pay interest on reserves to create a maturity mismatch across its long-term fixed-rate assets and its short-term floating-rate liabilities. To see where the risk comes from, consider a counterfactual, and this was actually the scenario originally conceived of by Friedman and Talley. Say that the Fed was paying interest on reserves, and after announcing the new interest on reserves policy, moved to satiate banks' demand for reserves at zero opportunity cost by conducting large-scale open market operations. But suppose that, using open market operations, instead of using open market operations as the Fed actually did to acquire long-term treasury bonds and mortgage-backed securities, say instead the Fed had just bought up very short-term U.S. Treasury bills. So this is like a ceteris paribus argument. Still there's interest on reserves, still there's a big balance sheet, but no maturity mismatch. And again, that was the scenario originally envisioned by Talley and Friedman. In that case, the Fed would not be earning large surpluses today because it would be receiving the same low interest rates on its short-term assets that it was paying on its liabilities, its reserves. On the other hand, there would be no risk as well, because as the Fed continued to raise interest rates, its assets would be rolling over so quickly that their interest rates would be reset higher as well. In fact, the Federal Reserve used quantitative easing not to acquire short-term treasury bills, but instead to acquire long-term fixed-rate assets. So in practice, the Fed has used its ability to pay interest on reserves to run what Marvin Goodfriend has quite aptly called monetary policy as a carry trade. Basically, it's issuing short-term floating-rate liabilities and using the proceeds to acquire long-term fixed-rate assets. That generates large surpluses so long as the yield curve keeps sloping up. But it also exposes the Fed to losses if the yield curve inverts, if the Fed raises short-term interest rates above the fixed rates that it's earning on its long-term assets. Now, to be fair, there have been a series of studies conducted both inside and outside the Fed, which I cite in the paper that I prepared for this session today, that assess that interest rate risk and conclude on the whole that the risk is manageable. I have no quarrel to make with any of the details of any of those specific studies. They're done by experts in the field, again, inside and outside the Fed. They're very competently and done and technically sophisticated. But on the other hand, here's what I would say about those studies. If you go back to the years before the financial crisis, there were institutions such as Lehman Brothers and Bear Stearns that were also running carry trade-like strategies. And I would assume that within those institutions, similar techniques were used to run similar stress tests, concluding similarly that the risks are manageable. And look what happened there. So my point is this. If I was on the FOMC, I perfectly understand why FOMC members want to move solely on the balance sheet to avoid disrupting financial markets by selling off treasury bonds and especially mortgage-backed securities too soon. On the other hand, if I were on the FOMC, I would also feel more than a little bit anxious about the risks of this carry trade and the risks in particular that it would blow up, costing the Fed money and then by extension costing the American taxpayer as well. And the same set of concerns would push me in the direction of saying, in the long run, let's just get rid of interest on reserves so that the temptation to restart this carry trade is eliminated altogether. So that's the economic risk. The political risk, it seems to me, looms even larger. Already, twice in the past several years, the U.S. Congress has tapped the Fed surplus, the profits from the successful side of the carry trade, to finance U.S. Federal expenditures, once in 2015 with a highway spending bill, and the second time just earlier this year with the bipartisan Budget Act of 2018. Every time this happens, the Fed looks less and less like an independent central bank, responsible for managing the stock of base money in order to stabilize the aggregate nominal price level, and more like an agent of the U.S. Treasury, charged with the task of coming up with trading schemes that allow Congress to spend more without raising taxes, without issuing additional Treasury debt, where the risk, it's not hidden because everybody can see it if they look hard enough. But on the other hand, it's almost like in the eyes of those who don't look hard enough, it's like magic. It's like money that comes out of nowhere, but it imposes risk on the Fed and on the American taxpayer as well. So again, if I were on the FOMC, I would see this as a game, and a game where, from my perspective, there was little to win and a lot to lose. So again, interest on reserves would be something that I would like to set aside in the long run to avoid temptation to start this whole thing all over again. So where does this leave us? It seems like there are benefits or costs. How do we weigh the two and come down? Where do we come down in the end? Fortunately, we don't have to decide, because there's another way of achieving most, if not all, of the benefits from a policy that pays interest on reserves while incurring none of the costs. About 10 years after he wrote the Program for Monetary Stability, Milton Friedman wrote another essay called The Optimum Quantity of Money, in which he outlined another strategy for achieving the efficiency condition in the market, not just for reserves, but for the entire stock of base money, household and firms holding currency, as well as banks holding reserves. The idea was to steadily contract the money supply, generating deflation, which would then reduce nominal interest rates and hence opportunity costs of holding liquid assets to zero economy-wide. Now, I fully realize that central bankers and economists as well tend to associate deflation and zero nominal interest rates with bad economic outcomes, not good outcomes. In their minds, zero interest rates and deflation are associated with the Keynesian liquidity trap, not with Friedman's rule for the optimum quantity of money. At the same time, however, I would also argue that we don't need to go all the way to zero interest rates and deflation to achieve most of the benefits of the Friedman rule, most of these efficiency gains. All we need to do is to ask the Federal Reserve to keep inflation and interest rates at positive but at low and stable levels. So that would be my preferred way out in the long run. Wind down the balance sheet as quickly as possible. Get out from under this risky interest rate carry trade. Do away with interest on reserves so that there's no more temptation on the FOMC's part or on the part of Congress to keep this going or to start it all again. And just go back to instructing the Federal Reserve to target inflation at a rate that's low and stable, producing nominal interest rates that are low and stable as well. The money markets would operate more efficiently. The entire economy would operate more efficiently as well. Thanks.
Let's just have one question. Hugh? We'll just have one, and then we'll move on, and we'll come back.
Thanks for your talk, Peter. It seems to me that an important distinction has to be made between interest on required reserves and excess reserves, because a lot of the case back before 2008 for interest on reserves was the banks game the reserve requirement, and so if we pay interest on excess reserves, then we could control the money, the multiplier better. But then somehow that extended to excess reserves, and excess
Yes.
reserves are a total different story,
Yeah.
because the way the Fed controls is a stimulative or contractionary is to create excess reserves that have an opportunity cost. If they don't have any opportunity cost, then it's basically rudderless, as I've
Yeah.
argued in a...
That's
in
right.
a-
That's
in
an
a-
excellent point. I actually discussed this a little bit in the paper. What's interesting is that when the Fed rolled out interest on reserves, initially they did make a distinction. They said we will pay interest on required reserves at the market rate based on the efficiency argument. And they also announced a policy of paying interest on excess reserves that wasn't zero, like you're suggesting, and I'd sign on to what you just suggested, but at least at a lower interest rate. And then as the financial crisis went on and the Fed wanted to conduct, basically they wanted to do QE plus massive emergency lending programs without allowing the increase in the monetary base to feed through into accelerated growth in broader measures of the money supply and then from inflation. Then they choked it off by paying interest on both excess and required reserves. So I agree with you 100%. The only thing that I would say, though, is to me, in the end, when I started writing, Mickey suggested that I write this paper for this session. And when I went into it, honestly, I was agnostic about where I would come down, partly because I liked the efficiency argument of Friedman and Tolley. But what won me over in the end to thinking that it's better just to jettison interest on reserves altogether, it's just the temptation. As long as this mechanism is there, people in Congress are going to see that there's a way of making it seem like government spending can go up, taxes can go down, and the U.S. Treasury doesn't have to issue any more debt. And even the Republic, everybody is going to succumb to that kind of temptation. So that's kind of why I would prefer just to cut it off completely and say, we're just not going to do this. We're going to achieve efficiency, or at least approximate it the other way, by keeping inflation low and stable. But good point.
Thank you very much. Let's move on to Mike Bordeaux.
So I'm going to change gears a bit and talk about something that we don't have, but we will have. I want to talk about central bank digital currency, future direction for monetary policy. So the current proliferation of cryptocurrencies, things like Bitcoin, Ethereum, Ripple, et cetera, by the private sector has created a challenge to the world's central banks. And although these things are touted as currencies, they don't satisfy the three classic functions of money: unit of account, medium of exchange, and store of value. Instead, they present potential challenges to both the payment system and to central banks and to monetary control. So the present discussion of over cryptocurrencies or virtual currencies reminded me of a debate over 2 centuries ago on free banking versus central banking. And the key players in the 19th century debate included people like Thornton, Ricardo, Mill, other people, Fullerton and Overstone, that no one else here knows about. In the 20th century, the debate was between people like Vera Smith, book on free banking in 1936, Charles Goodhart, 1987, and Larry White, George Selgin, and other people at George Mason. Okay, the issue in the 19th century was that many countries had competing commercial banks that issued banknotes that were convertible into silver or gold, and the notes were convertible, but the weights of the bases varied a lot, and the fineness, and that, in a sense, impeded the efficient operation of the payment system. Now, there's also the U.S. case when we were in the greenback period, when we didn't have floating exchange rates. or before greenbacks, when we weren't pegged to gold, that these were like fiat currencies too. So each country went through a process of standardization and consolidation, which ended up with the establishment of a central bank, which had a monopoly of the national currency. And examples include Britain, Switzerland, and the US. I just did a paper on Switzerland to see how this process worked. So what we do in this paper, what I do in this paper is this paper is based on research with Andy Levin, who's here. We consider the key specifications of something we call a central bank digital currency, and I'll define it. And we formulate a set of overarching design principles. And what we conclude is that if you had this, that could transform all aspects of the monetary system. It could give you a unit of account, which gives you true price stability, a medium of exchange, which is practically costless, and a store of value, which produces a safe asset with a secure rate of return. And also, central bank digital currency can provide a monetary policy framework which is systematic and transparent. So, just to define my terms, so a digital currency is an asset stored in electronic form that serves the same functions as paper currency. And virtual currencies are digital currencies established by private entities, like Bitcoin. They've been promoted as providing a safe and secure payment system, which is strictly private. They have two serious disadvantages, however. First, their real value fluctuates sharply due to changes in relative supply and demand. And secondly, verification can be costly and relatively inefficient. So in the case of Bitcoin, the mining, cost of mining consumes the electricity used by a pretty large city. And there's lots of articles in the press about how Bitcoin is looking for places where electricity is cheap to set up business. So in contrast to virtual currencies, a central bank can issue a digital currency that is fixed in nominal value and that serves as legal tender, just like present-day paper currency. And in fact, many central banks around the world are actively right now exploring the launch of their own digital currencies, and some have begun experiments with designs. Bank of Canada, Bank of England, ECB, Norges Bank, Riksbank, and a whole bunch of emerging countries. And many of the studies that have been done on this, they focus on the technical and logistical issues of implementing a central bank digital currency. They focus on issues of the payment system. So what we do is we're looking at the whole picture about of currency. And we raise several questions. First, should it be account-based, like debit cards, or token-based, like cash or stored value cards? Should cash be abolished, or should transfers between central bank digital currency and paper currency be subjected to graduated fees? Should it be interest-bearing, like commercial bank reserves that Peter just talked about? Or should it have a fixed nominal value like cash, or be indexed to some aggregate price index like tips? And then the last thing is, what are the implications of central bank digital currency for monetary policy goals, strategy, and operating procedures? Okay, I'm going to take a little more than 3 minutes, maybe 6. Okay. So,
Not with me here.
okay, well, then we won't. Okay, the first thing is,
compromise at 4.
okay, the medium of exchange. So we argue that it could serve as a legal tender, and it just like paper currency, and just like paper currency, there are these problems of increasing returns and externalities, which give you a rationale for why the government should be involved, why you should have a central bank. We talk about the ways in which central banks could issue digital currency. One is by tokens, like stored value tokens or cards. And the other way is by actually people having accounts at central banks. And we argue in the paper that there's a good reason to go the second route. Okay, and so we argue that you'd have these accounts in central banks, just like people did in the Bank of England in the 19th century, and these accounts would be because it's digital, the cost of using them would be absolutely zero. You would actually remove all the transactions costs in a payment system. The second is the store of value, and again we follow Friedman here from what Peter Ireland was saying, and that we argue that it should pay, like Friedman argued, it would pay interest on central bank digital currency, and the central bank digital interest rate would be the key monetary policy tool. And this would be the tool that the Fed would use to conduct monetary policy. And it could cut its interest rate below zero without any problems. In fact, you wouldn't have to worry about the zero lower bound. As far as a unit of account goes, it would facilitate all these problems that we've seen with these cryptocurrencies. People could just make choices knowing that the value of their currency would always be a constant over time. And the way the central bank would do this is, again, by altering the central bank digital currency interest rate. And so this leads us to directly to what monetary policy would do. So what you want monetary policy to do is to be a rule-like, to give you price stability, the things we've talking about. And so we argue that you could, in a sense, follow something like a price level target. Okay, a price level target, and in fact, it would be based on a Taylor rule, type like a Taylor rule, but it's a Taylor rule adjusted to price level target, and we have it on page 8 of our paper. And what would happen is it would be the rule would be a benchmark for adjusting the real interest rate in response to fluctuations in economic activity and prices. And when the price level is at its target and output is at its potential, then the ex post real interest rate would equal its equilibrium value. And so in this framework, the central bank would be able to respond to a severe output shock without resorting to QE or other measures the kinds of measures it's been following. The central bank's balance sheet would be highly transparent, with assets of short-term government securities matching its liabilities of central bank digital currency. And it would engage in open market operations in these short-term securities to satisfy the demand and supply for digital currency. The problems of monetary and fiscal interactions that we talked about today would disappear because the arbitrage is costless. The size of the central bank's balance sheet would be much smaller. You wouldn't have to worry about it. And also, with the obsolescence of paper currency, the central bank will no longer generate substantial seigniorage and would simply cover its expenses with small fees on payment transactions. It could also, with central bank digital currency, you could also operate a lender of last resort, because what you do is you just would vary this interest rate on reserves on central bank digital currency, and you could always provide the liquidity that's required in the case of a financial crisis. So these are some of the benefits that we talk about in the paper. I didn't have time to go through all of it, but the point I want to make now is that actually it's something that we should be thinking seriously about, because central banks have been renowned as conservative institutions, and doing something like this is pretty radical. But there are good reasons for moving expeditiously in the direction of adopting something like this. Given the rapid pace of payments innovations, not moving ahead opens up the possibility of instability in the payment system with multiple issuers of cryptocurrencies, as occurred in the 19th century with banknotes. An alternative scenario is, in the absence of competition from central bank digital currency, because payment systems networks exhibit increasing returns to scale, the entire payment system might even become quasi-monopolistic. And so under these circumstances, any significant operational problem with a payments network could pose substantial risk to the entire financial system. Central banks around the world are seriously contemplating issuing some form of digital currency in the near future. Andy and I have been traveling all over the place. Andy's going to the BOJ. Okay, he was at the Bank of England. I was at the Banque de France. They're really interested in this. And it seems that this may be the time for the U.S. monetary authorities to take this issue seriously. Thank you.
Let's start off with one question for Michael, and then we'll open it up to questions for both. Diana.
Hi, great paper. Quick question. With the very high-profile hacks we've had with Equifax, Office of Personnel Management, what is the danger of this digital cryptocurrency being hacked?
Okay, we talk a bit about this in the currency. So we say that if you had the account-based one, if you had the token-based one, that the cost, that the risks are reasonably high. But if you ran it through in a sense, if you had the Fed doing it, you could pretty well, you could reduce that a lot. You can never get rid of that, but it would be a lot easier. Do you want to? Yeah.
Sure. Let me just. So, as Mike said, an account-based system, actually, with a two-stage verification, which means that you have hardware and software, it's actually very difficult to hack. So, if you would guess, which is the first country in the world that introduced digital cash? The answer is Kenya. The Treasury Department of Kenya, in a public-private partnership with the cell phone company, is in an effort to try to provide a more effective payment system to underserved communities in Kenya, introduced digital cash. And the way it works is just simple cell phone text messages. The cell phone network knows your cell phone number, which is the hardware, and you have to use a PIN. So if you lose your cell phone, it's not a problem. You just contact the cell phone company. No one can steal your funds. This kind of two-stage verification is used in all kinds of things now. That's why I can use my, credit or debit card in Japan when I travel there. They can verify my identity. They can send me a text message and say, "Is this you?" Respond yes or no if you did the following transaction. And if I say no, it wasn't me, then they can quickly lock the account and make sure that no funds are stolen. So an account-based system, again, as Mike said, certainly there would be a tax on it, but Kenya's been running this for 6 or 7 years. They have 15 million citizens in Kenya, some of whom I'm sure are hackers, but that system's actually worked well, and 17 million people are using it, and small businesses are benefiting from it greatly. I think Mike didn't, he mentioned that a big advantage of digital cash is that it could really enhance the payment system for small businesses and consumers. Right now, paper cash is expensive for people to use.
Okay, let's open up our questioning more generally for both papers. Okay. And since we've had a couple of questions in a row on the second paper, can we take one? I'll go back and forth. Let's take one on the first paper. Is this about the first one? Yeah, Dr. Ireland.
The analogy that came, Guy Hazelman, the analogy that came to mind was about the special purpose vehicles, the SIVs, that every bank, not just Lehman or Bear Stearns, every single bank had tons of these off-balance sheet special purpose vehicles where they funded in commercial paper and then bought the longer-term CDOs and all those structured products. The reason the 2008 crisis got so bad was interbank lending basically dried up, and the reason it dried up was because every bank knew the other bank had as many SIVs as they had, and they were friendly because they were on the hook for the credit of that. So with that in mind, is it possible, so the Fed, as you said, is a giant carry game. That's why the banks did it. Is it possible, is there a scenario where the Fed would be forced to sell assets above the schedule that they have of shrinking it, or alternatively, where they would not be able to let the marketplace get ahead of them, and they would be forced so that their funding source didn't run away, they would be forced to keep interest rates at least as high as, and force them to do something they ultimately might not have done.
Yes, that's right. Or yet another disaster scenario would be, well, first, all of these things could be backstopped if there was an agreement between the Fed and the Treasury which said that if the Fed surpluses turned to losses, then the transfers would go in the opposite direction. Because then, right. But then you have to ask, is that really going to happen? That ultimately, what would prevent a sort of run on this game from playing out according to the same script as Lehman and Bear is that the Fed could always pay interest on reserves without selling its existing assets, but in effect by printing more money. I mean, they could just create more reserves to pay interest on reserves, but that would be that would be an inflationary outcome. So that's sort of my point. I mean, you can say, well, the odds the odds are high that it'll all end well, but what if it doesn't? And what does history say about people who make as their business model, well, let's just hope it all works out. Yeah.
Charlie, can I make a comment about this? So Peter mentioned there were some very insightful studies a few years ago about the Fed's balance sheet. Let me just put numbers on the table here. So it was a few years ago, in 2012 and 13, after QE had been launched. The risk scenarios that were identified by Bloomberg and by academics and financial analysts, there were reasonable scenarios where the Fed would lose $400 billion. Now, when I say lose, what I mean is that in order to keep their inflation target. So this is not the worst case scenario where they give up the inflation target. This is a case where in order to defend the inflation target, they have to raise interest rates more quickly, and they're earning a low interest on the mortgage-backed securities that they purchased, and they're paying a higher interest rate on the reserves that they owe to the banks, that they could lose $400 billion. Now, Congress, I think, had no idea of this kind of magnitude. The debates that have come up recently, I think it was mentioned in the morning session, the Congress appropriating $20 billion of the Fed. That was a controversial number. This is an order of magnitude larger, $400 billion. So even though Peter said, well, it's manageable risk, I think the truth is that if we had gotten into that scenario where the Fed had to raise rates quickly in 2012, 13, and 14, and the Fed had to come back to Congress and the Treasury and say, we need you to rescue us $400 billion, that would have been a very serious problem.
It's an interesting point, too, to note that on a consolidated basis, of course, if this were all U.S. government debt, there'd be no profit or loss overall. But it isn't all U.S. government debt. So now we're looking at the mortgage-backed securities transfer between the consolidated government portfolio and some issuers that aren't the government, which I think is another sort of wrinkle from the political standpoint. I think this is largely a political issue rather than a monetary policy operational issue. So I think those numbers are very interesting. Well, I don't see a lot of hands up, so I'm going to use the prerogative to ask a question. Oh, did we have somebody? Yeah. Debbie. You can go first. You have one back there. Thanks.
So this seemed like an invitation to repeat a recommendation from my work last time, which was to say that another way to discourage a large balance sheet is to mark to market. Mm-hmm. Right. Because then you would see the volatility not just in that rare instance that things really fell apart quickly, but they would be they would know constantly that they could show a loss position. And it would also reduce the temptation to treat the carry trade as a profit, because on a mark-to-market basis, it will look less so. So just wanted to point that out.
Agreed.
And we have another question. I think it's Brian.
Hi, Love the selection of papers you did here. Andy, I was invited to speak at the Kenya conference, so I look forward to catching up with you later on. But on the Peter's paper, Peter, you're right. You've got a great paper here, original contributions. Page 2, you talk about the Fed's assumption about the managing the supply and demand for funds curves, and that they really missed the assumption about how nominal price level is working. And you used price level, you didn't say inflation. So my first question to you is, what is your method for teasing out monetary-driven inflation from price level change? And then secondly, what power does the central bank have through the mechanisms that you laid out here to affect this stuff in a globalized financial market where you can easily circumvent central banks? And a bunch of us in this room, that's how we make our money, is circumventing central banks. Right. So how does this work in the world? And if you want to tie it into economic warfare, go for it, because that's a big piece of the shadow world here too.
Right. That's an excellent set of questions. First, regarding the distinction between the price level and the inflation rate, this is something slightly different from the issues that come up when people ask, should the Fed target the level or the growth rate of nominal variables? This is simply an observation that from an economic perspective, there is no other agent or agency within the economy except for the Federal Reserve that is capable of pinning down the overall level of nominal magnitudes. And the thought experiment along those lines, it's the traditional one where you would just say, if we all woke up tomorrow and the Fed or some other representative of the US government said, from now on, prices are going to be measured in terms of cents instead of dollars, then the thought experiment would be the aggregate nominal price level would go up by a factor of 100, and nothing, there would be no real effect. So what I was getting at with a reference to the price level there was simply that, the Fed, as our economy's central bank, is ultimately responsible for pinning down the level of nominal variables. What I would say about your second question, this is the standard economics professor answer to that question, which is to say that a wide variety of factors, monetary and non-monetary, can impact on the measured rate of inflation at any given time. And there may be limits, therefore, to the Federal Reserve's ability to achieve, let's say, 2% inflation on a year-over-year basis, let alone a month-over-month basis. But I would still be confident that if the Federal Reserve were to keep its inflation target at 2%, it could calibrate monetary policies so that over an extended period of time, inflation would average 2%. And if the Fed chose a higher or lower inflation target, it could do the same. But we could talk more about that at lunch.
Mickey, I'm going to let you ask a short question. I have a long question I want to ask the second paper authors. Go ahead.
My short question for Mike and Andy is, so you've written this paper, you've presented it to various, key global central banks, and as you said, there's prototypes and there's experimentation. And both you are very well known within Federal Reserve circles. How is the Fed taking to all this, and what is your assessment of where they go with this and over what period of time?
You can do that. Quickly, because I want to ask you a question.
Yeah, I'll be quick, because actually we have 2 sentences in our paper about this. The Reserve Bank of New Zealand adopted an inflation target in 1989. If I've got the dates right, around 92, 93, Bank of England, Bank of Canada, Bank of Sweden. Okay, 2003, European Central Bank. 2012, so almost 25 years after the initial adoption of inflation targeting, in 2012, the FOMC, and thanks in large part actually to Charlie Posner, he doesn't always get credit for this, but he worked really hard behind the scenes with Charlie Evans and other Reserve Bank presidents to finally get the Fed to a 2% inflation target, 25 years later. So now, the simple answer to your question here, as Mike said, is that central banks are conservative and cautious and inertial. This all came up in the earlier session. And the extent to which you see more of this now, that Japan might have a digital currency in 2019 or 2020. Sweden may have a digital currency in 2020 or 2022. When will the Fed, move to start seriously considering this? Is an open question.
Wait, what are they doing on their research of it now? How are they just tell us more about.
You're asking the wrong people.
They're not doing very much. I mean, I've talked.
Certainly not publicly out in the open.
Yeah, I mean,
that's for sure.
at Cleveland, they're thinking about it, but they haven't.
Actually, my question is going to get at this from a different angle. So, by the way, Rand Paul isn't here to ask this question, so I'm going to ask it. And I think it also explains why this is a very sensitive issue for the Fed to be involved in. And I'm going to have to even admit that I don't support your proposal. And the reason I don't support it is that, first of all, freedom is not a footnote in an economics paper. It's a fundamental tenet of our democracy. The idea of abolishing currency is very unpopular and is contrary to freedom. It was one thing for the government to monopolize currency, but then to do the combination of monopolizing it and prohibiting it is simply too much. Now, that's not an economic efficiency argument. That's beyond economic efficiency, and it's why if you go the entire way to wanting to make this all things, that is not just solving the cryptocurrency problem, which I agree with. Central banks should solve that problem by creating digital currency. I agree with you there. But there are two other steps I don't agree with, and that is solving the zero bound policy by abolishing currency, which of course Rogoff has also recommended. No, that I'm not going to let you do. And secondly, I'm not going to let you monopolize this by having individuals keep all their balances at the central bank, because I think that is too much a concentration of power, and I know it will be abused despite anything that your model says. Right.
Look,
I said it was a Rand Paul question, which is why it isn't a question. It's an opposition. So you can have all the things that have to do with stable money and central bank digital currency without monopolizing it.
Charlie, wait
a
just
minute. You
one
didn't
second.
read the paper, Charlie. In there, we do deal with these issues,
Well,
okay?
how?
So we don't say we should abolish currency. First of all, we talk about countries like Sweden where they are moving that way endogenously. Then we say one could impose these transactions fees to accelerate the process, which is already taking place. So it's not something we do. Secondly, on the monopoly issue, we also say in the paper that, and this is what the other countries are thinking about, is you could have a public-private partnership, okay? The way the Swedes and the Norwegians are talking about is have the commercial banks do it and back it by the Federal Reserve, but by their central banks.
So Charlie, because I think if you give me the courtesy of rephrasing your comments as questions, okay? Because they're legitimate, they're absolutely legitimate questions, Mike, and I have thought about these are questions that we've gotten in many places that we've been refining the paper and the proposal. Question number one is, are Mike and Andy suggesting that paper currency be abolished? And the simple, plain, absolute answer to that is no. I think that would be incredibly destructive. I think that there are a lot of lower income households, older consumers, small businesses that use cash and that will continue to use cash for quite some time. Okay, and so the idea that the government should suddenly abolish that it would be totally.
No, I didn't say suddenly. You changed it to suddenly. How do you have a negative interest rate policy without limit that works with currency?
Okay, that's a good question. That's a question. Okay, that's a question. And the answer to that, which we discuss in the paper, is a graduated system of fees on transfers between paper currency and digital cash. And so the way this works is that we say it's all in the paper, but in small amounts of the sort that a small business or a household would use, okay, the transfer fee between digital cash and paper cash would be free, could be free. Okay, what you're trying to do in mitigating the zero bound is to constrain the arbitrage in billions and trillions of dollars between paper currency and digital cash, and that can be done with graduated fees.
But that's a tax on cash.
It's not a tax on cash, it's a tax on moving between cash, paper cash, and digital cash. But look. The truth is, you who use paper cash know this already. You pay a 3% roughly. If you're withdrawing a couple $100, you pay a 3% ATM fee. Okay. Now, if you use your own bank, which some of you may do, if you're economical. Okay, I don't always do that. I'm traveling and I need to withdraw it at an airport. I pay $3. Okay, when you deposit your cash at a business, and they take it to the bank, they have to pay the bank 1 or 2% fee to do the sorting, cleaning, and so forth. Okay, so the truth is, there already are interchange fees between electronic forms of payment and paper currency. Now, if you move to a -1 or -2% interest rate for a year or 2 or 3, the ATM fees we already have, and the fees that banks already have charged small businesses to process cash would probably already be enough. So that when you say, well, we're imposing a new tax, the fees that we have in mind here would may well be smaller than the fees that businesses and consumers currently charge to use cash.
I think I succeeded in my Rand Paul imitation, and I think that was a productive exchange. So actually, we're out of time, I'm sorry. And what I have to do is, first, before we thank the authors, say to you, please pick up all your things and move yourselves and those things to the back of the room so that the tables can be changed. And now if you'll join me in thanking the authors for excellent papers.